if the economy was falling off a cliff and they didn't cut because they didn't want to seem like they were interfering with the inflection, well, that would be interfering with the election because they should really. I mean, I think the Fed. All right, so the Fed does lie. Powell has been using mendacity many times. My opinion, when he says I care about the country, I care about the people, this class of people, or I care about the poor people. If you really cared about them, Mr. Powell.
In today's news recap, silver is playing catch up, but is still more likely to be weighed down by CTA selling activity over the coming week. TDS senior commodity strategist Daniel Gali notes, silver fundamentals remain strong. Our simulations of future prices continue to point to negative asymmetries in positioning risks over the coming week, with a big uptape required to prevent CTAs from returning to the offer. Under the hood, this suggests that uptrend signals are naturally deteriorating, and in contrast to gold, Shanghai traders are now adding to their shorts following significant long liquidations that have greatly reduced the top traders' net position. Silver fundamentals remain strong, with solar capacity still beating expectations, and sentiment surrounding industrial demand may be overly pessimistic, but the scope for a significant reversal in sentiment to drive prices higher is mitigated by the recent rise in the free float and the pessimistic outlook for algo flows for the time being. Now, we'll show you more clips of the latest interview, but first, hit the like button, subscribe to the channel, and make sure you share this video with a gold bug, as more people need to know this. Let's get back into the episode.
I've heard a lot of people say, well, you just alluded to it. Well, a lot of debt is being issued on the front end, which causes yields to rise, which causes the front end to be higher. No, listen. The yield curve is inverted for the longest duration in history. Now, the yield curve inversion is one of the best predictors of recession. I think since 1955, every single time it was inverted, there was a recession, except for 94, and that's when GDP went from like 10% to 0.2% in the mid 90s. So it always presages a crash in GDP, and maybe it's because, well, banks don't really lend a lot of money when their cost of funding is greater than what they can get from their assets. So it's kind of like it's predictive, it's self-fulfilling. And I don't think it's different this time. I'm raising my hand and telling you right now, put me down as someone who says it's not different this time. The inverted yield curve, which was the longest inversion in history, it was one of the steepest inversions in history, is not going to end well for this economy, period.
And do we typically get, when we cross back across that zero line, what typically happens at those points?
Well, that's usually when the yield curve reinverts or normalizes. Let's just say normalize. In other words, when short rates are below long-term rates, it usually happens when the Fed assents to the idea that, hey, we got a problem here, and they start slashing rates. So they went from like 5.25 in 2007 to 0 by the end of 08. And so the long end says, oh, well, I'm going to go down a little bit because of a recession, because people are piling into that safety, but I'm not going to go down that far because, look, I'm not going to go to 0 because I know what's going to happen here. We're going to reflate the economy and yields are going to go up. That's normally the time when you want to sell your stocks, is when the yield curve normalizes, because the Fed is acknowledging that, hey, we got a problem. We're going to have a plunge in earnings, and that's not a good time to invest in stocks. And this is not happening yet. What's happening now is the yield curve it's still inverted, but it's like 20, 21, and 22 basis points inverted. And I guess it's the function that I was talking about. We have an insolvent nation that's been ravaged by inflation. So I don't think you're going to see the yield curve invert by 100 basis points. Once again, it's going to normalize, but it's going to normalize the same way it always normalized before. When the recession becomes fully manifest, the Fed is data dependent, Tom. They are dependent on data that is lagging. They are looking at labor market data, which is a lagging economic indicator. They're looking at GDP, which is a lagging economic indicator. My model, what looks at bank lending standards and the yield curve on the Fed's balance sheet, these are predictive algorithms to tell you where inflation is heading. I look at commodity prices, look at where inflation is heading. I don't look at what the CPI has done, reported in arrears, from the prior month due to what happened.
In today's episode, Michael Pento, president of Pento Portfolio Strategies, provided a stark analysis of the current economic climate, emphasizing the severe financial challenges facing the nation. Pento declared the nation insolvent, citing a staggering debt-to-revenue ratio of 730%. He highlighted that 40% of the nation's revenue is being added to the debt annually, exacerbating the financial imbalance. Assets minus liabilities clearly show insolvency, Pento asserted. The Federal Reserve's aggressive monetary tightening has significantly reduced liquidity. Pento noted that the Fed's balance sheet, which expanded from $700 billion to $9 trillion, is now being reduced, and bank lending standards have tightened. The jet fuel blowing into asset bubbles is drying up, he observed. The yield curve has been inverted for a record duration, signaling an impending recession. Historically, such inversions have reliably predicted downturns. Pento explained, it's predictive and self-fulfilling, and this time is no different. While financial conditions and credit spreads remain stable, Pento noted a slight erosion in high-yield bonds. He predicted that credit spreads will widen as economic conditions worsen, reflecting increased risk and reduced liquidity. We're not seeing it yet, but it's inevitable, he cautioned. Pento's investment strategy is defensive, favoring bonds and bond proxies in disinflationary environments. He warned against overexposure to overvalued assets, given the potential for significant market corrections. When credit spreads widen, it's time to get defensive, he advised. Make sure you hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our recaps. Also, check our description for full credit details if you want to watch the whole interview. Enjoy the episode.
The Fed's always behind the curve. Look at the Fed funds rate right now. It's 5.25, 5.5, 5.3 effective Fed funds rate, and the 10-year note is saying, I know what's happening. The free market is telling us what's happening. Mm-hmm. Yields are at 4.18%. So the Fed's just be following the interest rates, which have already collapsed. There's no predict. Tom, the Fed is comprised of labor market economists. I mean, they look at Phillips curves. So when too many people are working, that's inflationary. And when not enough people are working, it's deflationary. Mm-hmm. Nothing can be further from the truth. I mean, when people stop working and stop producing, there's less goods and services to absorb the money supply. So if you do look at history, there's actually no evidence that the Phillips curve actually works or has ever worked, but that's what they care about.
Right.
So if we have problems in the labor market, which I think we will have, the Fed will start cutting rates. But again, that is a lagging economic indicator. The last thing people do and companies do now is they lay people off. They're worried about they're hoarding labor still. I wouldn't be surprised if they had to companies acquiesced suddenly and they said, okay, I can't hold this labor any longer. And you see huge spike in initial claims and a huge spike in the unemployment rate, in the U3 unemployment rate. And then you're going to react. No, why don't you look at the money supply growth? Why don't you look at the level of the real Fed funds rate, which is positive for over a year after being negative for 20 years? Just look at that. That'll tell you where why don't you look at banks' balance sheets? Why don't you look at the inverted yield curve? That tells you where it's going. But even the Fed said, okay, you're right, Mr. Pento, a recession's coming, we will start cutting rates. cut them if you will, do the same playbook, but you might be unhappy with the results this time. Insolvent nations with an inflation problem don't tend to do very well when you pursue a course of inflation.
What do you think of Michael Pento's take? Do you agree with him? Will the U.S. economy collapse right after the Fed starts cutting rates? Post in the comments section your honest opinion, share your predictions for gold, silver, and the dollar, and watch this video right here because it's a perfect fit for you. I'll see you on the other side.